very warm welcome to this edition of Rush Hour here on ET Now. I'm Vikram Oza, and at the top of the show, let's focus on US GDP data. Now, US GDP has gone up at a 2.1% annualized rate last quarter. It has been revised down from that 2.4% pace that was reported last month. US economic growth revised lower to a still solid pace in the second quarter, but the momentum appears to have picked up early, and this in the third quarter, because we are seeing a tight labor market which is underpinning consumer spending. So the US economy has grown at a 2% pace in the first quarter, and it seems that it's going to continue to push ahead despite 525 basis points worth of interest rate hikes from the Federal Reserve since March 2022. Let's find out where the US markets are headed on the back of this kind of data. And for that, Jose Torres is with us, senior economist for Interactive Brokers. Great to have you back on the show with us, Jose. You have been digesting US GDP numbers. Now, what does that tell you? Because as far as the markets are concerned, it gives further clarity to them to a certain extent that the Fed will perhaps give growth that much more of a chance over the price rise and will go easy on interest rate hikes. What does it tell you?
Thanks for having me, Vikram. Well, I think that the most important piece of data from this revision was that the core PCE numbers also got revised lower. And what we saw from yesterday with the lower than expected JOLTS number, this market wants any data point that points to less Fed will be celebrated by this market, and that's what we're seeing. We also had ADP private payrolls this morning come in below expectations, and I think as we move into the later parts of the third quarter and the fourth quarter, I think that the focus is going to be less on bringing inflation down because inflation is coming down. I think the focus is going to be more on what are the costs of bringing down inflation. Of course, less job opportunities, slower consumer spending, and less momentum for servicers on the revenue side.
So what are the expectations on American inflation now, Jose, and how is that going to have a telling effect on what the Fed does in September?
Well, right now we think that September is going to be a pause just because these numbers were getting support more of a wait and see approach, but we do think that November is going to be the final hike, and we don't think we're going to see cuts till the second half of next year. We think that goods prices are coming down, commodities are a wild card. 1 month they go up, the next month they go down, and services have remained pretty hot, and that's a labor intensive area. So we think that if the Fed talks about pausing too early or even hints at cutting, we think that inflation will accelerate once again pretty quickly and go back up to 4%. We think though in the long term, next 5 to 10 years, we're going to be in a new era of 3 to 3.5% inflation.
Tell us about the global economy, Jose, because only yesterday, economists of the World Bank and IMF have red flagged these global growth concerns and perhaps hinting at a financial crisis unfolding because you're talking about tightening financial conditions, you're talking about lower growth in these current times. How is that going to play out in the markets as well on investor sentiment?
Well, right now, investor sentiment has been buoyant. I do expect that later on we will have some financial shocks. You know, this year we had the financial shock in March with the regional banks that the Fed quickly, by expanding its balance sheet about 400 billion, quickly got rid of that crisis. So we're going to see some additional problems in the next 6 months. I think that the markets are priced for perfection here, Vikram, quite frankly. I think that we're close to the highs of the year, the 46.07 on the S&P that we saw a few weeks ago. I think that's going to mark the high for the year, and we could be flat for a while from here just because valuations are really extended, fundamentals are all right, and bond yields are really high. And taken together, it doesn't add up for stocks to be where they are right now, which is at particularly lofty levels.
How much of a role are oil prices going to have, Jose? Because we are seeing those oil prices surge on the back of U.S. inventories falling and hurricane fears. But that is for the moment. Tell us about how these prices are likely to move in times to come.
Yeah, so oil has been very, very interesting. You have the demand story has been particularly bearish with demand concerns out of China. The US has been on the demand side has been particularly strong, but that can wane particularly quickly as we're seeing consumer spending wane. Then the supply story is really pinned on OPEC plus restricting production led by Saudi Arabia and Moscow. And then you also have the SPR from the US, and you also have the possibility of a reintroduction of Venezuelan barrels if the White House decides to relax sanctions on Caracas. So overall, it looks like oil can go either direction. It really all depends on the momentum of economic growth. And I would say if it was on one specific factor, it would be on China's stimulus. And we'll see how effective China's stimulus will be on its economy. If it's highly effective, then the price of oil will go up. And if it's not highly effective, it'll go down. Of course, assuming all other variables remain constant.
Well, that variable is China, and very restricted data coming in from China at this point in time where there are global growth concerns. China has a pivotal role in that sphere. But tell us about Chinese growth and how that's going to really alter the course of the equities now if we do continue to get negative data on the Chinese economy.
Well, the issue with negative data on the Chinese economy is that while it's negative for the Chinese economy, it's actually positive for inflation. And what we find is that although Chinese equities are doing particularly poorly for a while now, maybe about 2 years, the US market is doing particularly well, at least this year, right? So US investors and global investors, and if you look at Europe as well, has been doing really well this year. China's economic troubles have actually served as a tailwind to those equities. Also, the geopolitical situation, Vikram, has made it where folks want to not have as much funds tied to China, and they'd like to have it a little more diversified around the world. And then also, to your point earlier, higher interest rates and a stronger dollar give more of an incentive for folks to put money in developed markets rather than in Chinese markets.
So that might be a net positive to an emerging market like India, and we'll see how that plays out. But Jose Torres, many thanks for joining us with your perspective on this edition of Russia. Always good to have you on the show.
Thank you, Vikram.